Hello there and welcome to Oil Market Insight. You're joining us here at the headquarters of OPEC in Vienna on the eve of the 173rd OPEC meeting of the conference here. So we're delighted to be with you as always, bringing you up to date on what's been going on in the last few months since we met in terms of the oil market, taking a look at the economy and really looking at what's in store for all of the ministers as they arrive here in Vienna for this 173rd meeting. Joining me, of course, for this session, I'd like to welcome now Cornelia Meyer. She is the CEO of MRL Corporation. Great, as always, to have you here. Jason Schenker is with us, the president of Prestige Economics. And also today we're joined by Halima Croft. Thank you so much, the head of commodity strategy with RBC Capital Markets. Thank you all for being here. Now, Jason, if I could start with you and perhaps give us an overview of the economy. We've seen some strength come back into the economy. And of course, we're seeing the oil price hold up, for the last few weeks. There's some good signals out there, but bring us up to date, particularly in the last few months, where you see the state of the economy right now.
Sure, great. We're in a very different spot right now for the economy than where we were, say, a year ago. And what we see right now, the U.S. economy's been expanding, the Eurozone economy's been expanding, and the Chinese economy's been expanding. And all of that demand-side growth has been good for oil demand. And at the same time, you're also seeing the level of global inventories fall towards that 5-year average. So we're in a really different spot where demand is up and inventories are falling, and things look, generally speaking, pretty good for the next couple of years. So we're in a really nice spot economically.
And of course, this is one of the key issues that the OPEC ministers will be looking at. And talking about shale producers, Jason, I'm going to have you bring us up to date with what's going on in the U.S. We're looking at strength coming back in the price. And of course, this is often a signal for the shale producers, some of them perhaps to get back in the market. How is it looking in the U.S., particularly, we're looking at predictions of 10 million barrels a day for 2018. Can the market handle that?
Well, I think at the end of the day, the most important thing for the oil market is that that the price of oil is determined by the demand side more than the supply side, right? Commodities, oil included, are bought and not sold. And so even though we see more supply coming into the market, as you see higher prices, you've got still some real challenges with companies willing to make some of the investments they have to make because of what happened in the last cycle where prices fell so hard in 14, 15, and the beginning of 16. So I think there is a lot of money coming into the space and companies are looking to drill more, but they're all looking really for that sweetheart deal. And so you really see a bit more caution. But even if we get more supply, the upside risk to the global economy should not be discounted. We still have very loose monetary policy globally. In the U.S., you've seen very high levels of the purchasing manager indices, the US ISM. And in the Eurozone, we've seen over 50 consecutive months of expansions in the monthly manufacturing PMI and record levels in the German IFO. These things are very positive for growth. And at the same time, China's doing well. And the reason that oil inventories built between the end of 14 into 16, the reason that oil prices fell during that time was China was in a manufacturing recession between December of 14 and June of 16. And since then, we've seen China expanding. We continue to see China expand and the U.S. expand and Eurozone expand. Those things will be positive and they'll be able to absorb more supply of shale because the demand will simply be higher.
Now, Jason, we've certainly seen the market in the past be very sentiment-driven, and I think we can still see that. But again, throughout the year or two, it has been that sentiment, and again, everybody looking at what OPEC is doing, how they move, that's still very, very important to the market out there.
It's very important. It's probably more important than it has been in the past. And to echo things that both Cornelia and Hamila have said, if we look, something that happened when Barkindo became the Secretary General at the beginning of August, right, a year and a half ago, was that forward guidance came into play. You began to see statements about oil production cuts are coming. They're coming. They're coming. Now, the cut was made a year ago, but the verbiage around a coming cut began in August, almost from the very beginning when Barkindo became the Secretary General. That's been very important, and keeping that drum beating of compliance, of production being brought back in line, of inventories coming back towards that 5-year average. That drum is being beat in every oil market report, in every monthly report from OPEC, in all the PR communication. That's very focused, and Barkindo has very much been stressing that, and that the market has been very receptive to and has become aware of that, which does make, because you're talking more about it, people are more aware of it. So now that forward guidance, that increases expectations because people want to see something come to fruition once they've heard and seen so much about it.
Is it inventories we really have to be watching, Jason?
I think so. Look, OPEC doesn't explicitly have price targets, but that 5-year average for inventories, that's been right in sights of what's been a critical target. And, if we look at the communication and we look at everything they're trying to do, if OPEC was a corporation, we'd say that they're right-sizing supply for the moment. And that's true. But if we see demand continue, then, there's going to be less concern around this inventory number because the demand side will pull prices higher.
So, Jason, looking at the U.S. and looking at possible more shale production coming on board, when we again look to 2018, what do you think the main key focus has to be?
Well, I think there's two things. I think we see a strong economy globally and a good economy in the U.S. I think there's a high probability of tax cuts going through, which will be stimulative for the U.S. economy. But what that will also do is likely send rates higher at the back end of the curve. In other words, long-term interest rates will likely go up. And also the Fed is reducing the amount of principal it's reinvesting in its balance sheet. In other words, the Fed will be buying fewer bonds in the market, which also sends interest rates higher at the back of the curve. So that means that if you don't have the cash to drill the wells, the financing for long-term deals will become more expensive. So I think that's something that could actually help keep some of the shale activity a bit more in balance because higher costs of capital can weigh on certain activities.
So again, it's good news sort of as we close off the year. I mean, good, stronger economy. We've got a higher price. I think a lot has come together for what the ministers have been looking for. But again, as we look to 2018, this, of course, will be the room for, as they say, no complacency in this market, and they'll be really working hard. We do have to wrap it up there. I want to thank my guests. Thank you all so much for being with us. Cornelia, thank you. Jason and Halima as well. Thank you so much. That's it from Oil Market Insight for this edition. Of course, stay with us on OPEC.org and check in every now and then, and we'll have more interviews and more updates as we go throughout the day and throughout the week. Thank you so much.